think of this as are we incrementalists in the improvement, or are we seeing full scale change, like, going from pre the industrial age to making cars better, like a car that's kind of incremental. Do you see revolutionary change that can save us from our current fiscal and monetary doldrums potentially?
Well, that's a pretty loaded question, and I think there's a lot to think about. I would start by saying that I'm a huge believer in technology, and that I believe in the transformational power of technology. And I would say that the energy world is flat was in a way, basically a compliment to my fellow engineers, right? As one of my former colleagues at Goldman would say, if you give enough time and money to an engineer, he will solve the problem. You give enough time and money to a politician and he will get you bankrupt, right? So I think in that sense, I believe in technology, but the common theme between, and this is very important, the two books that I wrote, the energy world is flat and the anti-bubbles, go into something quite deep, which is ultimately the greatest simplicity, which is, I've done a lot of work on bubbles. I've coined the concept of anti-bubble. And the important thing with many of these moves is, I like to borrow Soros' definition of bubbles. Okay, he says bubbles are effectively artificially expensive assets that are supported by a belief that is false, that it's a misconception. So we are really dealing with a situation where the emperor had no clothes. Okay, these are real bubbles. Whether it's because I'm going to make $1 trillion making this expansion, or this technology is whatever. So if the key is to look for the belief and the misconception, if you find the belief and the misconception, the incremental thing that I did with the anti-bubbles is I said, look, I agree that misconceptions can distort reality, but not only with artificially high valuations, you could create artificially low valuations. Okay, a misconception can actually result in things being artificially expensive or artificially cheap. And these things are effectively mirror images of each other. And in a way, what happened with the energy world is flat is, for the longest time, we lived into this world where oil was on its own. Okay, you had no challengers. It was very difficult. Think about what would take to have natural gas competing with oil or electric or others. But once that technology came and that certain of those beliefs were challenged, then the emperor had no clothes, and then effectively you get this Babylistic dynamic. And I think that your question could go into several dimensions. I think if we go into the monetary side, one of the big ones is Bitcoin, right? You could argue that the technology, financial technology, is this really a game changer, or does the emperor have no clothes? Is this, we're always looking at, we know the problem, we know it, but is this, are we having a leap in the process that, is this really the right solution or not? And what you have is you see a lot of a process where what Soros would call the Twilight Period, right? Where both beliefs and misconceptions live together, and until eventually things calm down. And I think the biggest problems we're seeing, and is related to your point on wealth concentration and as a result inequality, is, and this is the biggest issue we're facing, and what I'm obsessed about and what I wrote about at length, is the belief that you can actually solve problems by printing money and taking debt. And in a way, this belief is supported by things like never fight the Fed, okay? Never fight the Fed, or whatever it takes, or China's PBOC is in control, okay? These are beliefs that are incredibly anchored into people's mindsets, but They're not true because, the Fed is not by printing and lending and the governments by borrowing and spending. This situation where you're effectively testing the limits of monetary policy and fiscal policy is not solving the problems. Okay, it's not solving the problems. It's doing four things. Okay, the first one is kicking the can down the road. Is delaying the problem by effectively through debt. Okay, the second thing is transferring the problem. So you have a situation where country A, by printing infinite amount of their money, is trying to dilute the value of their currency. It creates currency wars, is passing the problem to the neighbor. And these currency wars effectively lead to trade wars, which is the mirror image. Don't devalue by 20%. If you do, I'm just not going to let my companies send you my money, my investment, send you my jobs, send you my technology, just because you're 20% cheaper. I'm not going to let that happen. So you know what? If you devalue by 20%, I will tariff you by 20%, right? So trade wars is a mirror image of currency wars, which is effectively what's happening when you try to transfer the problem to somebody else. The third thing that happens is we are transforming this problem from bubbles to inflation. And this is, and eventually enlarging it. So when I summarize global macro, it's pretty simple. I mean, the last 10 years is the transformation of risk-free interest into interest-free risk. We haven't really solved anything. All we've done is we brought interest rates from, let's say, 5%. Your 10-year bond, your 10-year treasury was happily paying you 5% a year. And there was this concept in the textbook called R sub F, risk-free interest, which had two great things about it. The first one is you could earn 5% nominal with no risk in a low inflation environment. So you were actually making positive real returns. Thank you very much. The second thing that was happening is your 60-40 balance portfolio, if there was a crisis and yields went to zero, your 10-year bond or treasury or bond would make you 50% capital gains. So you had a great defender in the portfolio. Okay. In a world where interest rates have gone from 5% in the 10-year to 30% negative, 30 years, negative nominal yields like the bond, you no longer have the risk-free interest. Okay, we've been bullied into extending the duration. You no longer have the defender because obviously there's a limit to how far you can go in negative interest rates. And third, and most importantly, you have created bubbles without precedents. Because the maths are pretty simple. If you invested in a business, hey, Rodrigo comes with this great idea. Look, let's buy this stuff, and it's going to pay us $100 in 10 years, 20 years, and 30 years. In a world of 5% interest rates, the PV of the 10-year would be 61. The PV of the 20-year would be 36. The PV of the 30-year would be 21. Today, they're 100, 100, 100. So
this is part of also, I think, one of the issues that you didn't mention, but as a consequence was maybe your first point, which is there's an intergenerational transfer of wealth. And I think that fuels some of the discontent and some of the tensions that we're seeing across the globe with a lot of people protesting. Obviously, there are several layers and components to that, but I think part of that is that the millennials and the Gen Zers, they're not seeing anywhere near the opportunities as the previous generations have. And I think a lot of that has to do with debt overhang, right? This idea that 100%. We've borrowed too much to create. So I was curious as to, obviously, you see the actions of central banks as a big issue. What is the end game here? Obviously, you're expecting some form of inflation, specifically in asset prices. We've seen it. So I know that you are big on gold, and you sort of tangentially touch upon crypto. But what do you see the end game being here?
And maybe as you cover that, Diego, just cover the fourth point of the outcomes, because you got to three, I think. And
sure.
There was
it's related. It's related to this. So the fourth point is you are enlarging the problem. So you're not really fixing anything. You're making the problem bigger, and we get into this trap. Because obviously, when you have the crisis in 2008, you are forced to step in with monetary and just less fiscal. You are creating this intergenerational issue, and then as we went into COVID, you were effectively into what economists called pre-existing fragility. So you already had a very fragile situation, then this exacerbated it. But to follow up and answer the question about the end game, I summarize the next, just like the previous 10 years, where the transformation of risk-free interest into interest-free risk, the next 10 years is the transformation of bubbles too big to fail into inflation. And effectively, we need to understand, and I explain this, and I get the question again, because people are so hardly wired that it doesn't come across. So I'm going to say it as clearly as I can. We have a situation where artificially low interest rates have created bubbles across every single asset that are so huge that they are now systemic and they are the real enemy. So historically, if you take the textbook says, look, if inflation comes, interest rates go up, bonds go down. This is what the textbook says, and most people think this is written in stone. The reality today is we cannot increase interest rates. It's science fiction that you can increase interest rates. Because if you increase interest rates, the whole world implodes. Equities, credit, fixed income, anything that is discounted,
real estate,
the whole thing implodes. The whole thing implodes. Everything. Okay. So we're in a situation where you cannot hike interest rates, and then you have these problems which they tend to try once over and again to fix by printing and by money printing and debt. And effectively, what you're doing is, and this is, again, the central banks are playing this game, saying, well, the enemy is deflation, and we need to print all this money. And when you think about inflation, one of the critical things to understand is that inflation is not about the value of your house going up, or the value of oil going up, or the value of bread going up. Inflation is about the value of the money with which you buy your house, or oil, or bread going down. But somehow we're wired to think that my $100 will be $100 in 10 years. But the reality is that this is what I call the frog in the boiling water, right? The 2% inflation target is not a coincidence. It's calculated scientifically, in my view, to effectively dilute you as fast as possible without creating unrest, right? So we are frogs in the monetary pot, because you know that when you throw a frog into boiling water, it jumps. If you throw a frog into water that is mild and you just boil it up, it will die. At 2% per annum, after 10 years, you've been diluted by 20% plus compounding. After 20 years, you've been diluted at 40 plus compounded, right? So 20 years is, for me, is not what it used to be. Okay, 20 years used to be a long time, not anymore. and you think about how much you're being stolen directly through that with inflation at 2%, let alone real inflation. So the next thing is CPI is complete bullshit, if I may say so. I mean, in the sense that they fooled and they create this perception that inflation is just one number. Look, the four of us have 4 different inflation baskets. I mean, someone might have babies and has nappies. One of us is kids are in university. So inflation is not a single number. They somehow frame this into the CPI. And I use the analogy of global warming. I mean, we could debate at length whether there's global warming or not. But I can guarantee that if we give the thermometer to determine whether there's global warming in the world to Donald Trump, there's no global warming. And this is what happens with CPI. Come on, guys, there's deflation. Now, all this, let's not fool ourselves. There are huge deflationary pressures in the system. starting by unemployment, technology, demographics, overcapacity, bubbles, etc. All these huge deflationary forces are real. But this deflationary hole is being filled with money being printed at a pace that is unprecedented, and that effectively is diluting the value of money, and that will lead to a situation which is what I think is the next 10 years, which is the transformation of bubbles too big to fail into inflation. And this goes very closely to the point of inequality and to your point on wealth, etc.